Right, stop scrolling because what I'm about to describe is the most significant corporate crisis in the history of European automotive manufacturing, and it's unfolding right now in ways that will directly affect every British driver who owns, is considering buying, or has any financial exposure to the Volkswagen Group. Porsche, Audi, Seat, Skoda, Cupra, Lamborghini, Bentley, they all sit under the same corporate roof. And that roof has developed serious structural problems that none of the brands sharing it can escape independently. This isn't a short-term dip in sales figures or a temporary market correction. This is a fundamental reckoning with decisions made over decades, arriving simultaneously in a way that VW Group's management has consistently failed to anticipate and has repeatedly mishandled. I want to be precise about what collapse means here. Not administration, not bankruptcy, at least not yet and not imminently, but a systematic unwinding of the assumptions that made Volkswagen Group the world's largest automotive manufacturer, assumptions about technology, about market positioning, about labor costs, and about the loyalty of buyers who are now discovering alternatives they prefer. Stay with me. In 50 seconds, I'm going to describe the specific financial quarter that convinced institutional investors, not journalists, not analysts, but the funds managing billions of pounds, that Volkswagen Group's problems were structural rather than cyclical. When I tell you the numbers from that quarter and what they revealed about the group's cost position relative to its competitors, you'll understand why the share price has moved the way it has. But first, here is the number that defines the scale of this crisis. Volkswagen Group's operating margin, the proportion of revenue it retains as profit after costs, has fallen from approximately 8% in 2021 to somewhere below 4% in recent reporting periods. Simultaneously, its Chinese market sales, which accounted for approximately 40% of total global volume, have declined by over 30% as domestic Chinese brands have taken market share at a pace that VW's own internal forecasts didn't anticipate. These two trends arriving simultaneously have created a financial pressure that the group's cost structure was not designed to accommodate. Margin halved, China volume down 30%, simultaneously, on a cost base that was built for a completely different competitive environment. Subscribe right now. Drop a comment telling me whether you own a VW Group vehicle, any brand, and whether this news changes how you're thinking about your next purchase or the residual value of your current car. Because those answers matter practically and immediately. Let's get into it. To understand what's happening now, you need to understand the decisions that created these vulnerabilities, because this crisis didn't arrive suddenly. It was being built across a decade of choices that looked reasonable in isolation and look catastrophically compounding in combination. The first structural problem is cost. Volkswagen Group's German manufacturing operations carry labor costs that are among the highest in the global automotive industry. German automotive workers are paid well, protected by strong union agreements, and employed in numbers that made sense when the group was growing and when its products commanded sufficient premium pricing to cover those costs comfortably. The union agreements that protect those employment conditions also make the workforce very difficult and very expensive to reduce, creating a cost floor below which the group cannot easily descend regardless of revenue. When the market was growing and VW's positioning was strong, this cost structure was manageable. As revenue has come under pressure from Chinese competition in the critical Chinese market and from structural challenges in the European EV transition, the fixed cost base has become an increasingly significant problem. A business that needs to sell a certain volume to cover its fixed costs becomes very vulnerable when that volume is threatened. The second structural problem is the EV transition. Volkswagen Group committed publicly and emphatically to electrification. CEO Herbert Diess famously staked the company's future on an aggressive EV strategy, investing tens of billions in the MEB electric platform and positioning the group as a leader rather than a follower in the transition. The problem wasn't the direction was correct. The problem was the execution. The software crisis is the most concrete example of execution failure. Volkswagen attempted to develop its own in-car software, the Cariad division, rather than using established third-party systems. Cariad became one of the most expensive and most visible failures in modern automotive history, delaying multiple model launches, introducing software problems across the ID. Range that damaged the brand's technology credibility at exactly the moment when technology credibility was becoming the most important purchase consideration in the EV segment. The ID.3 launched with software so compromised that cars were delivered to customers with known faults, subsequently addressed through dealer updates. The ID.4 had charging reliability issues that attracted sustained negative press in multiple markets. The Audi e-tron's Carriad software contributed to infotainment experiences that didn't match the premium positioning Audi's pricing implied. Every one of these issues landed in the media at a moment when Tesla was demonstrating what integrated software development done correctly looked like. The comparison was brutal and unavoidable. The third structural problem is China. For most of the past 2 decades, Volkswagen Group's Chinese joint ventures were the engine of the company's global profitability. China was the market that grew reliably, year after year, absorbing large volumes of VW, Audi, and Skoda products and generating returns that subsidized operations elsewhere. German automotive executives treated the Chinese market as a durable asset, rather than as a position that needed active defense. Meanwhile, Chinese domestic manufacturers were developing. BYD, Geely, SAIC, and numerous smaller brands invested in EV technology, software development, and design that specifically targeted the preferences of Chinese consumers. When Chinese domestic EV brands emerged with products that were technologically competitive, better adapted to Chinese consumer tastes, and priced aggressively, VW Group's Chinese joint venture volumes began declining at rates that the group's internal forecasting consistently underestimated. The assumption of Chinese market durability turned out to be wrong, and the financial consequences of that wrongness are now flowing through the group's income statement with full force. The financial reality. The financial quarter I referenced at the opening was Q3 2024, the period when Volkswagen Group's results confirmed to institutional investors that the cost-revenue mismatch was structural rather than temporarily cyclical. The operating margin figure was the specific revelation. Volkswagen Group's core VW brand, not the group overall, but specifically the Volkswagen brand that gives the group its name, reported an operating margin that fell below 2%. That is a margin level at which a manufacturer of volume cars cannot fund the capital expenditure required for product development while also paying its workforce and servicing its debt. It is a margin level that signals a business whose cost structure and revenue base have moved into fundamental misalignment. Audi's results were less dramatic, but significantly below the premium margin levels that justify Audi's positioning in the market. A premium brand that cannot generate premium margins is paying premium-level costs to produce mainstream-level returns, which, over time, requires either a reduction in costs, an improvement in revenue per vehicle, or a sustained period of financial support from other parts of the group. Porsche, which was separately listed in 2022 at a valuation that briefly made it one of Europe's most valuable companies, has maintained stronger margins than the rest of the group, but its connection to Volkswagen Group through ownership structures means its fortunes remain intertwined with the group's overall health in ways that the separation of its stock listing doesn't fully insulate it from. The capital expenditure implications of these margin levels are significant and underappreciated in mainstream coverage of the crisis. Developing a competitive new car model costs between 1 and 3 billion euros depending on platform sharing and complexity. Developing competitive battery electric vehicles at the pace the market now requires costs more. VW Group's reduced margin means reduced internally generated capital available for these development programs, which means either reduced investment, increased debt, or asset sales. All three are occurring simultaneously. What's happening to each brand? The group's response to its financial situation has involved decisions that affect each brand differently, and understanding those differences matters for current owners and prospective buyers of each brand's products. Volkswagen brand itself is facing the most fundamental restructuring. In late 2024, Volkswagen AG announced it was considering closing German manufacturing facilities for the first time in the company's history, a decision that would have been considered unthinkable a decade ago, and that reflects how severe the cost-revenue mismatch has become. The union response was immediate, sustained and combative, with IG Metall threatening industrial action and senior union representatives publicly warning of consequences for the company's social contract. The compromise that emerged involves job reductions through voluntary departure schemes rather than facility closures, alongside wage freezes and reductions in some bonus structures. It reduces costs, but less dramatically and less quickly than the financial situation arguably requires. The underlying tension between the group's financial needs and its labor obligations remains unresolved rather than settled. Audi's crisis is somewhat different in character. Audi's premium positioning means its margin problems come from a different direction than VW's volume problems. Audi has been unable to charge premium prices that buyers believe are justified relative to competitors from BMW or Mercedes, and increasingly from Korean and Chinese alternatives that have entered the premium space with products buyers find credible. The e-tron range's reception, the CARIAD software problems, and a product cycle that has left some segments with aging models have all contributed to a brand perception challenge that financial engineering cannot easily resolve. The Q8 e-tron, the replacement and rebadging of the original e-tron, has performed below expectation in most European markets. The A6 e-tron, while generally well reviewed, launched into a market where the technology credibility deficit that CARIAD created was already affecting purchase consideration. Recovering brand trust in technology-intensive products is a slow process that requires consistent delivery rather than announcements. And Audi has been better at announcements than consistent delivery in the EV period. Skoda and Seat/Cupra are caught in a different version of the same problem. These brands have historically derived their value proposition from offering VW Group engineering at lower prices, the reliability and quality of the platform at an accessible price point. As VW Group's overall financial pressure forces cost reductions across the platform, the engineering quality that justified that value proposition comes under pressure. Skoda and Cupra buyers are paying for shared engineering. If the shared engineering is degraded by cost reduction, the value proposition weakens. Porsche's situation is the most complex within the group. Porsche AG's separate stock listing in 2022 was partly a mechanism to raise capital for VW Group at a time of investment need. The IPO generated approximately 19 billion euros, a significant portion of which flowed to VW Group as majority shareholder. Porsche's operational performance remains strong and its products are genuinely desirable globally, but the governance structures connecting Porsche AG to Volkswagen AG and to the Porsche and Piech family holding company create interdependencies that mean Porsche cannot be fully insulated from group-level developments regardless of its own operational health. Stop. Because everything described so far is context, the financial structure, the strategic failures, the brand-specific situations, all of it matters. But what matters most to you watching this is what it means practically. What does it mean for the residual value of your current VW Group vehicle? What does it mean for parts availability and dealer network stability over the next 5 years? What does it mean if you're considering buying a new or used Audi, VW, Skoda or Porsche right now? And what does it mean for the warranty and long-term support that comes with those vehicles? These are the questions that the financial coverage of this crisis consistently fails to answer for ordinary drivers, because financial journalists are writing for investors, not for people who just want to know whether the Audi A3 they're considering is still a sensible purchase. Drop a comment right now. Tell me specifically which VW Group brand and model you're most concerned about, whether as a current owner or prospective buyer, because I'm going to address the practical implications directly. What it means for current owners and buyers. For current owners of VW Group vehicles, the most immediate practical concern is residual values. Brand perception affects residual values through used market demand, and sustained negative coverage of any manufacturer's financial health affects how confidently buyers approach that brand's used products. This effect is real but typically gradual rather than dramatic. Used buyers care about the specific car in front of them more than about corporate governance structure. The more significant concern for current owners is dealer network stability. Volkswagen Group dealerships in the UK are independent businesses operating under franchise agreements with the manufacturer. If the group's financial difficulties translate into reduced marketing support, reduced new car supply, or reduced warranty claim processing efficiency, dealer businesses come under pressure. Some will exit the franchise. The dealer network contraction that accompanies manufacturer financial difficulties means potentially longer distances to service centers and reduced competition in servicing, both outcomes that are mildly adverse for current owners. Parts availability over a 5 to 10 year horizon is where the risk is highest for high mileage owners of older group vehicles. Manufacturers in financial difficulty prioritize parts supply for current models over older ones, which is rational business behavior, but adverse for owners of vehicles outside the current production window. This is a medium-term concern rather than an immediate one, but it's worth factoring into decisions about whether to invest significantly in older VW Group vehicles. For prospective buyers considering a new or nearly new VW Group vehicle, the practical calculation is more nuanced. The Group is not going to collapse in a manner that removes warranty support or parts availability within a new car's primary ownership period. The EU and UK regulatory frameworks governing manufacturer obligations to warranty holders provide meaningful protection even in extreme financial scenarios. The immediate risk to a new car buyer is lower than coverage of the crisis sometimes implies. The medium-term concern for new buyers is whether the Group's cost reduction measures affect the quality of vehicles coming off production lines in the next 2 to 3 years. Cost reduction programs in manufacturing typically show up in materials quality and manufacturing precision before they show up in reliability. The engineering in the platform remains sound while the execution becomes less precise. This is difficult to identify without extended real-world ownership data from the new model cycles emerging during the restructuring period. Used buyers of recent VW Group vehicles face a genuinely complex picture. The combination of the financial crisis coverage and the specific product problems in the EV range have created a perception discount on VW Group products in some segments, particularly on ID series electric vehicles, that may represent either an opportunity or a justified market assessment depending on the specific vehicle. For buyers considering conventional petrol and diesel VW Group products in proven specifications, the value case is in some ways strengthened by the discount. Well-regarded products becoming available at prices that reflect corporate anxiety rather than vehicle quality. The Volkswagen Group's crisis is real, significant, and not close to resolution. The structural problems, cost-based misalignment, China market volume loss, EV software credibility deficit, product cycle timing, are not problems that can be resolved in a quarter or resolved through a single restructuring announcement. They require sustained management execution over several years, and the Group's recent track record on sustained execution doesn't provide the confidence that its announcements sometimes try to generate. For British drivers, the practical implications are real but proportionate. VW Group is not disappearing. Audi, Porsche and Volkswagen are not going to stop being recognisable, supported brands in the UK market in any time frame relevant to a current purchase decision. The risks are subtler: residual value pressure, dealer network contraction, quality discipline during cost reduction, parts support for older vehicles. These are real risks worth incorporating into purchasing decisions. They are not crisis-level risks for individual vehicle owners in the near term. The Chinese market situation is the variable that most determines the Group's medium-term trajectory. If Chinese volume stabilizes through either improved product competitiveness or market share recovery, the financial pressure reduces to manageable levels. If Chinese volume continues declining at recent rates, the structural adjustment required becomes significantly more severe, and the implications for the Group's global operation become commensurately more serious. What you can do right now: if you're a current VW Group vehicle owner, understand your warranty position and whether your dealer network has shown any signs of instability in your area. If you're a prospective buyer of a VW Group vehicle, the conventional petrol and diesel products in proven specifications represent reasonable value, especially used. If you're specifically considering an EV from the Group's ID range, be clear about the software trajectory and what current software state means for your specific vehicle's long-term development. Drop a comment. Tell me which VW Group brand you're most connected to, whether as an owner, a prospective buyer, or someone who's already decided to look elsewhere as a result of this situation, because the pattern in those responses tells me exactly what to cover next on this subject. Subscribe and hit the notification bell. This story is developing, and the financial results and strategic announcements over the next 12 months will determine whether the Group is managing a difficult period or experiencing something more fundamental. This channel covers it as it develops. Right then, that's it from me today. Thanks for watching, and remember, the world's largest automotive group becoming its most troubled is not a small story. It's one that affects every driver in Britain, whether they own a VW Group vehicle or not. See you next time. Cheers.